no mai haere mai, ki tēnei hui. Not the most popular session I've ever chaired, but anyway, we have provided the opportunity if people so wish to attend.
It's super popular.
It's popular with a very discreet group of people. Oh, look, here's another one. Great. Okay, so I think we're going to go to the team first for the presentation, and then we will have questions if there are any, but I'm anticipating we won't be here for an hour. Thank you.
Sounds great. Kia ora koutou. So there's a Disaster Resilience Fund decision around the statement of investment policy and objectives is coming to the committee on the 20th on Wednesday. Now, this follows previous decisions made, firstly around adopting long-term plan amendment, in which we set the financial strategy and to deal with those two financial risks, being the underinsurance gap and undiversified investment portfolio. And one of the ways to help mitigate that was setting up the Disaster Resilience Fund. So there's been previous decisions made around selling some of our ground leases to capitalise the fund, and this is just to gain momentum now to align with our financial strategy. And there will be further decisions coming post-election. So there's three kind of key documents that are required for setting up, establishing and capitalising the fund, and that's around the Disaster Resilience Fund policy, governance documents, and the SIPO, which is what we're talking to you about today. So I'm just going to pass over to Sarah to run through the next slide.
Thank you. Kia ora, thanks for turning up. So essentially, there's probably too many words on these slides, but they're just hopefully to get our thoughts on paper as to why we're bringing you this ahead of sort of governance documents, as Rona mentioned. Look, we're doing this as a wee bit of a preemptive step so that we actually have a set of instructions to hand over to an investment manager in the event that we receive proceeds from any or all of the ground leases before we have a chance to establish the governance around the fund. So it's a safeguard really to make sure that we've got those rules. We've taken feedback from the councillors on how they want to set those rules, noting that the SIPO itself is a rather clinical document, if you like. It's an external policy that we would hand over along with the money and then empower someone else to invest that based on the rules that we set. I think I've covered most of that, but just probably that point there, it's important to have a direction for the investment manager so that they're not just putting it into government bonds without a decent return on them. First of three documents, like Rona said, so the SIPO is the external one that we hand over. The internal policy, or the DIRF policy, will be our internal processes akin to our Treasury or investment policy that we have to have under the Local Government Act, although this one won't be a statutory document, and then the governance documents, which we will hold over to incorporate into the standing orders and committee structure of the new in the new triennium.
So essentially we're bringing this decision to you now because we need that guidance around what we invest those funds in. We will likely receive, it's possible we could receive funds from the sale of those ground leases in advance of other decisions being made around the structure of the fund and the governance of the fund. So like Sarah said, in order to keep that moving, we want to get that direction now so that we can pass that to an investment manager. And in doing so, we've asked for delegation to the CE to use the SIPO as direction for what we're investing in. I've covered off most of this in my intro. So just a reminder on the recs for the paper is agree that in principle draft statement of investment policy and objectives. That final will come to you along with the suite of other documents because there's some things in there that will need to be updated once other decisions are made. To delegate to the CE to act upon the SIPO, and we will continue to draft all other policy documents for decisions to come back post-election. I'll leave it there and pass over for any questions. He Pātai.
Yes, Councillor Chung.
I'm looking at the statement of investment policy. Isn't it quite clear from the purpose of this fund? So isn't the purpose of this fund to get the maximum returns in the event of a disaster? So therefore we wouldn't be looking at any, I guess, short-term, 3-year, 5-year sort of investments. We'd be looking at something long-term to maximise the return?
So that's the decision we're looking to make through this. So there's always going to be inherent trade-offs between selecting different growth funds versus aggressive funds versus more stable funds like government bonds, as was mentioned earlier. So we're looking to you for that guidance. What we've presented in the paper is I won't use the word bland, but I'm going to use the word bland. Basically, a document that asks you for that. If you're comfortable with how it's scoped up, it's scoped up in quite a neutral tone. But if your directive to us is to look to maximise return on any investment that we make, then that will be the instruction that we give to the investment manager. Yes, that's one of the possible outcomes.
But because the fund is actually there for emergencies, for resilience, why would there be any other option other than maximising? I mean, we certainly don't want to sort of take bits out of it. Any time we need to build a new bike rack or something.
That's definitely how it's being structured up. It's not there as a sort of rainy day fund to pay off debt or similar. Those decisions will come somewhat through the governance structure as we bring that back to you, and as our advisor calls it, the belts and braces around how we invest that. I can't quite remember his metaphor, but effectively the more safeguarding you put on that. But we do also have to be mindful of the fact that it's a relatively small fund, so there's a cost benefit to that. How much we invest into setting up the structure versus how much we're actually going to return on the fund. So those are the decisions we'll bring back.
Just to add to that, so there's the decisions as well around the distribution. So, for example, one of the principles and what drove the consultation for setting up this fund was that there was no impact to ratepayers in the short term. So that means we have to look at what distribution is kept in the fund versus what distribution is allocated to offset our rates. So those kind of decisions will come post-election. Yep.
Councillor Rogers.
Yeah, I was just wondering, I apologise, I haven't read the paper thoroughly prior to this briefing, but I was just skimming through and looking at sort of some of the distributions amongst asset classes, and I was wondering how, I guess, the council could take a useful position in the modelling that we're doing for insurance to sort of provide some more certainty to the fund managers about the likelihood of a withdrawal of the fund, so they know how to sort of balance assets across things that are easily liquidable and assets that are, I guess, less easily liquidable.
We can certainly fold that into the insurance modelling that we're doing. We are, as I'm sure you're aware, we're also investigating a captive insurance, which we're doing the feasibility for at the moment, and that will be somewhat instructive on the size and amount of an event and what impact that would have on our credit rating by proxy of going like the hit that we would take to our balance sheet, and there's a tipping point where we can take a loss of X amount before we kind of trigger that downgrade due to this event. So there are certainly some parallels that we can pull out of that and help to inform.
Yeah, because I guess the bit that I'm thinking about is kind of from the investment standpoint, and this kind of, I guess, trying to answer a very unknown is kind of what is the time frame in which the council may experience an event, and then sort of what's the path that we would go along to decide, okay, we're going to make a withdrawal and it's going to be of this amount, and we need the money available in this time frame.
Yeah, the liquidity versus maximising the return on your investment. So the longer you go, the more risk, therefore the higher return. Look, we've got other mechanisms, and this will form part of the solution. It's not the only solution, but you rightly pointed to insurance before. So we currently have traditional insurance only. We're investigating parametric as well, which would kick in as a first order capital injection. We have our liquidity policy within our treasury policy. That means we have to have a certain amount of liquid assets, either through short-term term deposits or standby facilities. So it's about getting the cash in the door in an orderly fashion, and this will be one of those mechanisms. So we will find a balance to instruct the investment manager. Some of it might be able to go out long because we determine that maybe 50% of it would not be at risk, and so you can invest it more aggressively, and a portion of it would need to be liquid and easily accessible just in case.
Yeah.
Yeah.
Because we don't have the sort of like, I guess, the aspect of the parametric insurance yet. When I talked to the sort of head of insurance for Christchurch, one of the things they learned from the earthquake down there was around some of their insurance was about, the cost of replacement. And so their insurers in some cases were requiring that they built the replacement and then they reimburse them for those costs. So I guess I'd be interested to know in this scenario if we have situations like that, whether there's obviously the captive as well, but how much this might play in the role of providing the upfront capital and then a reimbursement being made to the DIRF.
Yeah, and I think elsewhere in the decision-making papers, I can't remember exactly which one it is, we very much have that decision coming back to you about what the trigger is for it. And we've, I think we presented it in the workshop that we presented back in June that Raina referred to, in that there needs to be obviously an event, it needs to do X amount of damage. So it does fold into the insurance test, but that will also determine whether it gets paid first, last. Insurance proceeds can take years to negotiate, to go through courts, etc. So we're looking to stagger those returns back to council as and when we need them to rebuild. Is that helpful?
Councillor Brown.
I'm curious about your risk evaluation, because it would seem to be that liquidity risk versus value risk were actually quite separate issues. And I'm so curious as to whether you see it that way. And I suppose the liquidity risk is an awkward equation because of this total uncertainty thing, but we are looking to insure for a 1 in 1,000-year event, so it could be 1,000 years. But of course it might be tomorrow. Yeah, exactly. Fingers crossed. But the value volatility issue is the more awkward one. And I mean, how are you going to get a relatively unsophisticated group of councillors to actually understand?
No offence.
Well, of course, present company accepted. Well, most of present company accepted. But how are you going to get people to understand? Because as we saw with the sludge minimisation facility issue last week, understanding risk is not one of the core competencies of some of the people in this room. And I just wonder how you're actually going to manage understanding of the risks associated with value. Because if you go all in on the S&P 500, as opposed to, as you say, going on a government stock, you are looking at prospectively a far better longer-term rate of return, but obviously prospectively far more volatility of outcomes. So you've got two questions there. One is around liquidity and one's around value risk, whether you see them separately, and the other one is around kind of getting people to understand and be comfortable with value risk.
Andrea, look, we have had debates about how we can invest it, and I think those decisions will be made at a later date. And I do set it in the example of where we have other forms of liquidity coming in. I don't know if I'm asking your question because it was. So your question, can I just replay it? Yeah. So what we invest in to maximise return versus other objectives, is that what we're trying to get to? Making it available. Mm-hmm. Mm-hmm.
I'll leave the mic on.
Oh, that's a good idea.
So, you get the New Zealand Superannuation Fund, obviously, which has the big advantage of being able to say, we don't need to touch our dough till 2035, so therefore we can invest in illiquids. So the liquidity risk is one issue, which clearly our event is kind of, has its own uncertainties. But once you've decided on the liquidity risk issue, 1 in 1,000 years, 1 in 6 minutes, what do that horizon. But then the other one is around the value volatility that you're willing to take on board. Where obviously government stock has got limited value volatility. S&P 500 has got heaps, so you've got these two separate. So my first question was, are you looking at the value risk and the liquidity risk as separate issues? And then secondly, your kind of views around the value risk.
I can perhaps start, and Sarah, you can jump in. But I think per Sarah's answer before, there's going to need to be a bit of an evolution here as other initiatives that we're bringing online, like the parametric solution if we do, or like the captive, as we think about how we could respond in an event. So, certainly in in the immediate future, we'll be looking to build the fund as best we can, but recognising we have limited other options if we were to face a disaster. So, and we also need to be thinking about that in the context that we still haven't decided what kind of dividend structure we're going to apply to this. We've looked at this like the ordinary dividend structure as how much of this is going to go towards offsetting rates, and then the special kind of dividend or ability to extract in those unique environments, what is that going to look like? So we're going to need to look at that quite carefully. So while you'd kind of want to separate out liquidity and the value aspect, we're not going to be able to do that right from day one, I don't believe. But over time, we would start to do that as we think about the other layers in terms of our insurance and what we're able to draw on. I think that's how we would look at this over time, because we're just not at that level of maturity yet. We're starting at the beginning, and we need to look at those other levers that we can actually apply. Geordie's absolutely right, from what happened in Canterbury and Christchurch, the insurance money wasn't flowing until costs were actually incurred, and that's the reality. And until you put something like a parametric in, that could be the same situation that we're in. So we do need to look at this as a maturity spectrum over time, in my view. But Sarah, you might have some more thoughts now.
Yeah, just within the document, we have tried to capture that in a bland sort of way by allocating a certain amount that needs to be available within a certain amount of time. But ultimately, these things will be played out as we go through this. We're talking about $60 to $70 million that needs to grow. But we're equally looking back to the councillors and elected members who need to help us make these decisions, and perhaps back to that other question about what the trigger is for releasing this money. If that's really, really onerous, you'd be waiting 1,000 years, and you'd have the capability to grow it and whatnot. So as we develop these other documents, I think hopefully that will play out through there, but be respectful of the council's wishes in this, because we're sort of trying to take a neutral tone, give you a little bit of a blank canvas, but staying within the documents as standard form documents, if that makes sense.
I'll just quickly add there as well. So obviously there are decisions that will come post-election around governance, and as part of that, we will be looking to make sure that there are independent members of whatever governance structure we have that do have some capability in the space to be able to make the decisions and implement any governing documents and the SIPO, for example. So it's not that we're going to have a room full of people that don't understand making the decisions as well. I
guess I would disagree with that approach. We're allowed to kind of debate the thing. The trouble is that it's for this body, for the councillors, to set the risk parameters. Now, they obviously have to do so on the basis of recommendations, but the governance body should be trying to optimise the returns within the risk parameters that it's actually allocated. I mean, that's certainly like people like New Zealand Superannuation Fund and other, things like that. That's their basic model. So they have a role, but it's not to set the risk appetite, and or to kind of say, how do we interpret that risk appetite? Because that's for this body to decide. Their job, as I see it, is to actually take that. Like if the people around this room say, this is a very long-term fund, we're happy to invest, we'll take some, value volatility risk and liquidity risk because we're committed for the long term, that's going to have significant impacts on how that is actually turned into a policy or activated as an investment strategy or parameters. But it is going to be for this, I would have thought that the people around this table, so
It does depend, though, Councillor, how this investment is set up, which we haven't made decisions on, and as to whether or not this is our committee of council, and so that's one, or whether it's a CCO, and then you would send. So it depends on the level of influence that you would have, depending on the makeup of the structure of this thing, and that's one thing that we still need to work through, because at the presentation that we did when KPMG came in and talked about the trade-offs, we were originally going to recommend a committee of council that kind of oversee this, and of course that will depend on whoever the elected mayor is, what their desire around that committee would look like, with our advice, of course. But if it's a CCO, it takes a different form as well, and how do we oversee that? So there is, as Rainer and Sarah have pointed out, there are three kind of critical documents here. At this point in time, we are looking at the SIPO, recognising that they're all interlinked, and I absolutely agree with you. There does still need to be a level of direction from this council. It just depends on what form that takes.
No, I get that's a good point. But just actually one question about that. I mean, if it's a council-controlled organisation, surely it's got to be subject to income tax.
Yes.
So we wouldn't want that. So surely we actually had to have direct investment.
That's exactly like all of the trade-offs. And so we need to work with the new group of elected members to understand what those trade-offs and where they're wanting to take. Because we looked at that and said, actually, a committee of council is probably best to oversee this with an investment manager for all of these reasons. However, there were some around the table that were reluctant with that approach because they wanted it at arm's reach from council. And so they were looking at a CCO. Now the trade-off of that means that there's additional cost, right? And that was pointed out, but there's cost versus protection of the fund, and those were the kind of things that people need to weigh up. So we feel it's appropriate to bring that decision to the new council at this point in time. However, we may have funds coming in the door because this council's already agreed to the sale of ground leases, and so we need some direction in how that money should be invested. In terms of process for that investment, we are going to have to be more conservative at this point in time by default, and that's exact. But it would be still in accordance with the SIPO and what this council have decided, because it's still important that we take the direction from this council.
Thank you.
Okay, Councillor Young?
Thank you. Online. So just thinking about this fund, I mean, I guess one of the things I'm concerned about is we could have a fantastic return, but we also have to think about the costs of running it. And has any thought been put into making it, as they do in some parts of Australia, part of the New Zealand Superannuation Fund? So we just piggyback off that?
So that, yes, we would look at all options in terms of who the investment manager actually is, Councillor. So those all options will all be brought back to the new council when it's elected.
Thank you.
Deputy Mayor Foon?
Yeah, kia ora tātou. And actually, I think mine will be coming off the back of Councillor Young's. I wasn't clear through the paper how we were going through the process of choosing an investment manager, even in this temporary format. Could you give some guidance on what that looks like, please?
So at this point in time, we won't be appointing an investment manager, Deputy Mayor. What we'd be looking at doing is we may have funds come in. They're not likely to be the full suite of funds that you've agreed to as per the sale of ground leases. That will take time. But we would be looking to invest via a treasury function, but with the delegated authority of the Chief Executive. So that's the second part of the REX, to invest those funds in accordance with the SIPO, and then creating the structure as soon as possible after the elections to move from that point forward.
Okay, thank you for that.
Can I just add, I think there's the intention to have a RFP or a procurement to select the investment manager. Yes, we will go through that process properly.
Okay, yeah, great, thank you. Just the next question then, in terms of probably bouncing off Councillor Brown's question, if we're starting to invest now and, you know, will we have the fluidity to say the next council wants to take a different approach, that wherever we've got the investment that we can then start to change it toward the, you know, where the policy really sets us, the direction we go with that?
Yes, we'll take your direction on that, but we will necessarily have to have that as liquid funds so that they can be liquidated to then better meet the needs of the council of the day.
Yeah, great. Thank you. I've put a few questions in the Q&A, so I won't ask them now. Thank you.
Thank you, Deputy Mayor. Councillor Chung.
Thanks very much. I think having an investment manager, of course, is a additional cost to this, as has been mentioned. But is there a danger that if we get the council, and of course I believe that the council should actually make the decisions, but is there a danger that we all have personal experience with different types of investment, and so that may not be necessarily the best thing for the council to be doing? Say, like, some of us might have, you know, share funds or something, and others may prefer fixed bonds or something like that. So we've got this mixture of different types of experience. So is that actually best for the council, or should we actually look at some other way, some other cheap way of managing it?
Cheaper way, okay. Return on money. Look, the council's role in this is to set the direction or the what we call in our treasury policy the guardrails. So you're not sort of instructing on a day-to-day basis what fund gets or what money gets allocated where. Rather, you select asset classes and you nominate which ones are in and out and instruct that way, and then the investment manager, back to Councillor Brown's point, it will be their role to maximise the return based on those guardrails that you have set through the allowed for investments. Does that answer your question?
So can I? So how when we do the SIPO, does it have a lot of detail on it? Like, for example, would it have something like, if we have a particular share fund, would we have rules in there to say that, if this goes down to 70% of what we actually paid for them, then we'll sell them, and so that it actually guides our behaviour, or do we say, or, you know, and of course you can do the other side, that if it reaches 200% of what we pay, we will sell them. And so does it give us those rules, or not?
I don't think we would be that prescriptive, definitely not through the SIPO. I think the investment committee, whatever form that takes, may look to apply those through the internal policy if they're relevant, but I think we trust in the investment manager that we appoint to make sure that they are managing the funds on our behalf in the appropriate way that we set. So, like I said, we select an asset class and perhaps a, can't think of the word for it, but like a balanced versus growth. We set certain percentages or ranges, and then we give it to them to maximise the return on that.
Councillor Rogers.
Maybe this is far too specific around wording. I was just looking in the fund purpose. It sort of talks about how in 2025 the long-term plan amendment established the fund, and then it says in part to address a current underinsurance risk. I guess my understanding would be that that's the major purpose, like it's And I don't know what
Apologies if the wording is off. That is or trying to articulate that this is only part of the solution as
Right.
opposed to it's only part used for that. Sorry if I've not articulated that well, but obviously we need this tool plus other tools to
I
make
see,
sure that
yeah.
we fill that,
Okay.
meet
Fantastic.
that. Sorry.
Yeah, no, that's good. Thank you.
You might want to have a look at those words. It's fine. Okay, great.
Yeah, and we can add, and when we introduce the paper on Wednesday, we can just perhaps add that clarity, just so that everyone else is clear. Yeah.
Do you have a paragraph reference so I can?
Oh, so it's part of the SIPO
okay.
under Part 2 Fund Purpose, Paragraph 2.
Perfect. Thank you.
All right, I think that has brought us to the end of the questions. So thank you so much. I appreciate. Yes, we'll give you half an hour back. Kia ora.
Thanks, Chair.
Thank you. See you.